Welcome back to another episode of Multifamily AP360. And today's our guest is Andrew McNair from Swan Capital. Welcome, Andrew.
Hey, I'm so excited to be on here.
Likewise, thank you very much, Andrew. And little bit about Andrew. Andrew is like founder of Swan Capital, managing over 300 million in assets and a seasoned real estate investor who exited an eight-figure portfolio. He's also a sought-after speaker, author, and host of Rich and Powerful, where faith, finance, and legal legacy intersect. So with that, Andrew, you want to add anything to your background?
That's a pretty good one. I hope I can live up to it.
Awesome. So you founded Swan Capital, sleep well at night. That's a powerful brand promise. How did your personal experiences shape this philosophy, and what does it really mean to sleep well financially?
Yeah, Sleep Well at Night, we specialize in working with retirees. So we're helping them put together a financial plan that consists of typically fixed investments, stock market investments, as well as real estate investments, both passive and active. And so we want income in retirement. We don't spend assets, so we spend income. So what we try to help clients do is sleep well at night so they can actually not have to think about their money. Like clients ask me all the time, you must really love managing these investments. You must like love being behind the computer screen. And I do love what I do, but in retirement, I don't want to do that. I don't want to be looking at my kids over a computer screen, like saying, hey, I'll be there in 30 minutes. No, I want to be spending time with them in retirement. And that's what most people want to do.
So most people talk about acquisitions, but you successfully exited an eight-figure real estate portfolio. So what made you decide to exit, and how did you know it was the right time?
Yeah, great question. So I started by reading a book called Rich Dad Poor Dad at the age of 14. And that purple little book flipped my world upside down like it did a lot of people. But it scared me so straight that I wanted to have a completely different lifestyle than a lot of people that I grew up with. And I decided that real estate might be the way through. And so what I did is I started interning at a financial firm from 14 to 18, started seeing my own clients. And when I started having success with my wealth management firm, I thought, hey, I'm investing alongside clients. My money is invested in the same portfolios there is. My income is tied to how well they're doing. But what happens if the stock market goes down? I'm going to lose my investments and I'm going to lose my income in the same year. So I thought real estate might be a different path. And so I started accumulating houses. By the time I was 25, I had 25 houses. That's multifamily, duplex, triplexes. And then by 30, I had 50 houses, and that was about 130 apartments. And what happened was I started losing my hair, like the blood, the sweat, and the tears of managing all these properties, and the decision fatigue of having multiple businesses caused me to recalculate and realize that for the next decade, I'm going to have to do it differently, that I'm going to have to reevaluate how I go forward. So that's where I found out that most real estate, especially the larger projects, become a team sport. And that's where I'm going to have to maybe bring clients alongside me and invest in really great projects. And that's where I invented the Signet Fund. But so I exited those 50 properties, over 136 apartments, because I could just see that my ROA calculations based on what I had purchased them, what I had now invested in them, because most of those houses were now paid off, that I had so much equity tied in, I would either have to refinance and strip all the equity out so that I can increase my ROI, or I was going to sell them. And so after COVID, after the hurricanes that we have had, it was a great time because little did I know, the Lord was looking out for me because taxes ended up increasing because so many people moved here after COVID. Insurance increased because of the insurance costs. Some people completely not riding in the state of Florida any further. And so it was the perfect time to exit it. And that's exactly why we did it.
Cool. So what did that liquidity event teach you about identity and freedom and the next phase of stewardship?
Yeah, identity is a whole nother rabbit trail we could go. I decided that for me, I struggle with greed a lot. So the one way and the, again, anti-venom for greed is to give it away. So I ended up giving most of that money away. So nearly $10 million, I ended up giving it all away because it really took the wind out of the sails of the greedy voice that lies within me. And so that's why I decided to give it away. But what it taught me is that from a financial standpoint, is real estate is both passive or active. Very rarely is real estate investing truly passive unless you have another money manager or you're having an investment within a fund, because most of the time, the decision fatigue of managing your own properties can wear on you, especially when you get into your 50s, 60s, and 70s. Or what happens if one of you, if you're married, passes away and you love to mow the lawn, you love to collect rents, but you can't no longer do it? So many clients will interrupt and say, I have a spreadsheet for my wife. And I'm like, a spreadsheet can't talk. Maybe with AI, it can do some, but it's not going to coach your spouse into doing something they already don't enjoy doing and they're not interested in doing. And they may not do it to the degree you do it. Like I just sat down with a couple that had 3 rental properties, and the ROI and the ROAs were completely all over the place. They were making anywhere from 4% rate of return, which they better off buying a CD, compared to 16% rate of return. And I thought, this family needs coaching on when to raise the rents. And if you're not running it like a business, you are doing yourself a disservice for the future.
Thank you. So you're invested across nearly every real estate asset class, like multifamily, RV parks, storage, industrial, short-term rentals. What's the one asset class you double down on today and why?
Yeah, if I would double down right now, we have a big interest in more office. I think office has got beat up so bad that there are going to be some great office opportunities. So we, in our 2024 Signet Fund, put around 4% of the portfolio into office. And so we're looking for more opportunities where we can have long-term triple net leases where we can go in, add some value. People still need a place to run their business. And so we have extensive flex industrial exposure, but we want to have more and more some office space exposure as well.
Good. And any asset class surprised you the most, either in performance or complexity or operational complexity?
I think I mean, I wouldn't say it was surprising. We should have seen the trend coming. And so we just want to be careful with any short-term rentals. Short-term rentals are going to continually change with the changing dynamics of how these VRBOs and Airbnb platforms are requiring various guests to actually do and take care of amenities that otherwise hotels would do for you. So I think we've seen a softening and probably a peak on short-term rentals. I think it'll continue to be a sizable asset class, but we may have seen the peak.
Got it. Thank you. So you managed 300 millions in assets and also built a real estate empire. How do you compare the wealth building power and emotional experience of public markets versus private real estate investing?
Yeah, I think most people are too religious with their investments. I think that you should be more agnostic. And again, that's how you were raised and it's who raised you. If you were raised by a stockbroker, you see nothing regular white colored flags because you're wearing rose colored glasses. Like I was blessed. I was raised in a firm that understood that you need a little sugar, a little flour in the kitchen to have any good dish. You're going to need some bank and insurance investments. You're going to need public markets, but you're also going to need real estate as well as potential debt instruments. And it's a true story that I met one of my heroes that I won't throw under the bus, but I met a hero that was just so sold out that never invest in public markets, only invest in real estate. And they were dogmatic about it. And we almost came to blows because he was so dogmatic that all of your money and your retirement accounts should be wrapped up in real estate. And it's just not the case. Both asset classes have value. The nice thing is when I manage my own rental properties, I can raise that rate of return to high double digits because I can put my own time, my own spirit, my own ideas into those properties. Luckily, Tim Cook is not calling me, asking me what we should do about tariffs with Apple products. I'm glad I got my own problems I got to worry about. I got my own tariffs I'm actually paying. So I think it's really important to understand like the value of each asset class and not try to talk other people out of it, especially if you're not a financial professional. Like you should leave that to the pros, keep your own financial advice to yourself instead of sadly taking other people's astray with you.
So what's your favorite asset class today and what's one you're avoiding now?
My favorite asset class is, I don't know if I have a favorite. I truly am agnostic to them. So it depends on the person's situation. Like when I'm giving advice to someone and I see someone that's heavy in just a 60-40 bond portfolio, I say, how sad. You should strip some of those bonds and utilize more fixed guaranteed investments. And you should utilize more real estate and strip away those bonds. So if I was going to be if I had a bias against a certain asset class, I'm not as big of a fan of bonds or variable annuities, for example, because a lot of people don't understand the inner workings of either. Bonds have high interest rate exposure, and they also have stock market exposure. People think for some reason that bonds are safe. And this has come to light in 2025 is bonds are not safe. They just have less risk than stocks, which if you don't have a finance degree, most people don't know that until it's too late. And then things like variable annuities, for example, they have high fees. I actually just met with a client that had $1.1 million in variable annuities and that someone had sold her, and she was paying $36,000 in fees on that 1.1 million. And I was just blown away how someone with a $5 million net worth on 1 million alone was paying $36,000 in fees.
Great. Yeah. Cash flow or appreciation, which has created more actual wealth for you?
I work with retirees day in and day out. So appreciation is, of course, very important, but cash flow is what gives you that confidence and that permission slip to spend more in retirement. So I'm a big fan of cash flow, but it's about blending the two. And so when we're putting together a financial plan for a retiree, we need to have some assets that are heavily focused on appreciation. This is where we utilize Roth IRAs to be that appreciating asset. Even if I have a client that's very risk averse, doesn't like public markets, we're going to have them heavy typically in Roth IRAs that are aggressive and growth focused in our Swan Growth and Swan Aggressive portfolios, because the reason is that's the last money we would ever touch. Most of the time, we're going to leave that to the children tax free. And so why not take a lot of risk with that Roth capital appreciation focus and then have the other assets in real estate that are going to send the cash flow payments to the client's checking account?
Yeah. Operational lessons you learned the hard way in real estate.
Oh yeah, I mean, it's not a straight up and to the right journey. My life has looked like a corkscrew of failures and things that have set me back. One of the biggest setbacks is by the time I was 16, I'd saved up $62,000 waiting tables, and I was making $0 an hour working at the financial firm. And I doubled it in the stock market in 2008 and 9, turning it into $142,000. So by the time most people were graduating with a diploma, I had rolled up dollar bills of $147,000 in my hands. And so I thought I had the Midas touch. And it was one of the best things that ever happened to me. And it haunts me still to this day. And it actually is a duplex that's right beside the church I go to every Sunday. It was a beautiful church, it is a beautiful church, but it was actually, I was going to say it was a beautiful duplex. It needed some love and attention. They wanted $72,000 for this cash flowing duplex. I had $147,000. You know what my idea was? What I was going to do, Rama, is I was going to buy that in cash, keep my money in the market, keep it doubling, or at least that's what I thought I was going to do. And I was going to take this cash flowing property, and it would be my first landmark house at the age of 18 that I bought in cash. And I was really excited about it. I told my realtor, hey, I'm going to sell out some of my positions and I'll get with you to purchase it. And less than, I think, a month later, I had nearly lost 25% of it. And then over the next year and a half, I ended up losing all of that $147,000, not buying that duplex. I actually did a search because I love pain and suffering for some reason. I did a search last year in preparation for another book I'm writing. And that house sold, I think, a year or two ago for $250,000. And I did the lost opportunity cost calculation of all that cash flow that I would have got for that 10-year period, that appreciation of that property, my rate of return would have been exponential. And I probably lost somewhere in the tune of $300,000 or $400,000 in potential gains that I was one not diversified, that it cost me $250,000 of appreciation, which is really sad.
Yeah. Yeah. What kind of metrics do you look at first when evaluating a new real estate deal?
When evaluating,
What kind of metrics do you look at when you're evaluating a deal?
oh, so when we're interviewing operators for our Signet fund, is spelled CYGNET. It's a baby swan that go along with our theme for Swan Capital. And so the first thing I'm going to look at, because we're investing institutionally for clients, is we're going to look at background checks, bad actors. I'm shocked at how many people do not run background checks and bad actors. We've had some surprising things come up in people's history. And like, I would not let them babysit my child. I wouldn't let them babysit my money because they have some sketchy pasts. And maybe people turn over new leaves. And I know people can change. I believe people can change, but I'm not going to let them see or test if they're going to change with my client's money. So the second thing we're going to look at is we're going to look at their track record. We're going to see how their business plan has worked out on the deals that they are very proud of and the deals they're not. I want to see the communication style of what it was like when the deals were going sour. What was that like? Did you not send them anything? Or were you actually repeatedly going back to the clients, telling them and making them abreast of what the situation was like as things were spiraling sadly down?
Got it. Got it. What's your plan for next few years?
My plan for the next few years is continually developing our Signet fund and making it better and better. And we also want to continually work on our new fund, the Nest Fund, which is a private credit and energy fund that we have created as an alternative income fund for our retired clients. I probably have one more fund up my sleeve. I'm not ready to reveal that quite yet. And then our Swan portfolios, we're continually building out our track record of our decision making there, making a meritocracy that I took from the book Principles by Ray Dalio to really develop how we're making decisions with our portfolios and how we can do that more consistently over time.
Awesome. So let's switch towards personal side. Any habits that are helping you to be successful?
Oh, habits that have made me successful. I think people underestimate how hard it is and how much work it'll take to be successful. If someone would have told me how hard it is to build a business, accrue the real estate portfolio that I was, told me how hard I was going to have to work, I'd probably have not done it. That's the beauty of not knowing the future sometimes, because you're like, wow, I didn't know how it was so difficult. I think the habit is one, staying humble enough to know that you don't have all the answers and being thirsty for education so that you don't have to make the trial and error for yourself. And this is why people should read biographies. This is why people should be readers, because you could go through life slowly making all the same mistakes that everyone else has, or you could study other people and try to avoid them. That's what I try to do. And that's why we try to read a book a week to make sure that we're constantly sidestepping some of the mistakes that other founders and other investors have made.
Awesome. Any one personal learning that played major role in your personal or business life?
I missed the first part, probably a bad connection. What was the first part?
Any personal learning?
Personal learning?
Yeah.
I think that the personal learning is a lot of what I've learned in Ecclesiastes. That's one of the best books is Ecclesiastes. Is it taught me that you could spend your life trying to accumulate wealth and you'll probably find that it is like vanity. It's wind grasping it. Anyone that's ever tried to grab air and grab wind is pretty fruitless when you try to do that. And that's what it's like. But a lot of people say, give me a shot. Let me win the lottery. Let me become successful. Let me become an NBA player. Let me become the best in my field. Then I can tell you myself if money made me happy, or I'll tell you if wealth made me feel at peace. And I can save you a lifetime because I've seen it play out over 600 times with retirees. I've played it out in my own life. All the people I've had on the Rich, Young, and Powerful podcast, they don't find happiness with more wealth, more fame, or fortune. They just don't. And they don't find it with more sex, more fame, more professional success. They don't find it. They only find it when they have a purpose, ideally linked up with their creator, that they find true happiness and peace. And so, yeah, that's one of my favorite books and one of my own personal lessons that I would wish I could share with every young person.
Okay, cool. Thank you. Any one book that impacted you more other than what you mentioned? No.
Yeah, financial books. Oh man, there's so many financial books I can mention. I'll say from a business standpoint, because I know probably some business owners are listening to this, is I love The Road Less Stupid. The Road Less Stupid by Keith Cunningham is a fabulous title, first off, but it's a fabulous book inside because it teaches you to start scheduling some thinking time. I don't think a lot of people think. I think a lot of people do, but I think we don't think enough. And no one taught me to think, and no one taught me that I should schedule thinking time and do it. And so it takes you through a series of questions as a business owner, as an investor, that you should be asking yourself so that you can get reflective, get introspective, and try to flesh out like how you can separate yourself from competition, take better care of your team members that you're working alongside, and then try to avoid some mistakes that we all fall prey to.
Awesome. Thank you. How can listeners can connect with you, Andrew?
Thanks for asking. The first thing I would recommend is that you check out the Rich, Young, and Powerful podcast. Right there is where we bring on everyone from celebrity, professional, NFL, NBA, everything from musicians to business, just moguls, onto our show to share about the purpose and the foundations and the charities that they support. Because I truly believe that life is not about just receiving and getting, but about giving. So check that out. Check out my book, The Giving Crisis, on Amazon and Audible. And then check out my website if you're looking for financial advice at swan-capital.com. That's Sleep at Night Capital. And that's where you can find out more information about Signet, our Nest Fund, our Swan portfolios, and things like that.
Awesome. And thank you very much, Andrew. Thank you.
The pleasure's mine.
Awesome. Thank you.